What is up, YouTube? Welcome back to Stocks by the Numbers. Wanted to dive into a company here, J M Smucker Co, ticker symbol SJM, listed here on the New York Stock Exchange. Company closed 147.89 a share, down about 0.1% on the day. We're looking at a 52-week low of 119.82, 52-week high 163.07. We're a little bit near the higher end of that range. Now, this company just posted earnings. As you can see here, numbers on your screen, you're seeing a slight beat there on the EPS side by about 3.5%. On the revenue side, the company came in just slightly under estimates, missing by about 1.2 million. Still posting 2.2 billion for the quarter, though one of their better quarters going back for the last 4 or 5 quarters at least. But looking at some of the numbers here, you can see market cap 15.7 billion. The company's paying a 2.75% yield for you to own shares of the stock, and we have a PE of about 28. So let's check out what's going on here. Looking on the EPS side, you can see for the last couple of quarters, consistent beats going 4 for 4. Obviously, very good sign. Come down quarterly, we look at the revenue, and you can see bouncing around the low 2 billions. Last quarter there, Q1 of 22, the company posted 1.87 billion in revenue for the quarter. However, right after that, coming back with 2.2 billion. So even though they did have that one dip, this company has basically been maintaining about $2 billion a quarter in revenue for, at least the last 5-6 quarters. So extrapolate that times 4, $2 billion a quarter times 4 is $8 billion in annual revenue. Again, company market cap $15.7 billion. So I like to do the yearly revenue to market cap comparison on this channel. And if we do that ratio, we can see that the company is trading under 2 times yearly revenue, which may, at first glance, show us that the company is potentially trading at a discount. However, again, we have a 28 PE, plus they kind of slightly missed earnings on the revenue side, so they might have, I don't want to say they might get beat up, but in the short term, they may just pull back a few dollars there. I wanted to switch over here to look at some of the numbers because, again, this will further indicate why, in my opinion, we're going to continue to sell off at least a few dollars. And it might not seem like a big deal, but again, it's all about pricing and timing. So if you're tucking away shares for the next 3, 5, 10 years, it's all about that entry level. And why force ourselves in here at 147.89 when we could buy it at 137.89? Is it a big deal? No. But at the end of the day, extrapolated over the years, you're going to come back and you're going to say, damn, I wish I could have saved $10, $12 a share on that, and it would have worked out even better now, 6 years later. But let's look at some of the numbers here. We're looking at the PE. It's a touch below 28. As you can see, going back to 2015, that's basically the highest it's been, right? So that can pull back a little bit. Price to sales, 1.94, highest it's been since 2016 of 1.98. And the years in between, it was chilling basically between 1.6 and 1.8. Now it's at 1.9. So that could indicate that a little bit of a pullback is coming. The price to cash flow sitting at about 15.9 times cash flow. Again, the highest it's been going all the way back to 2015. So that can indicate that we can have a pullback here. The price to book of 193, you can see in 2015 and 16 it was trading about 2.1 times book value. But again, since then, 1.6 to about 1.8 over the years. So sitting at 193, again, could indicate that we could pull back a little bit. The enterprise value, which is basically what another company would pay for it, again, market cap 15.7 billion. Enterprise value right now sitting at about 20.5 billion. So you're looking at about a 33% premium if another company was to buy out or approach J M Smucker right now. Now, you can see that the numbers have bounced around over the years, but going back to 2015, which it looks like here, based on a lot of these numbers, was one of the higher, healthier years for J M Smucker, and the enterprise value was 20.43 billion. And it has not gotten above 20 billion for 6 years, and it is now sitting at 20.48 billion, slightly about 50 million above the enterprise value back in one of their higher years. So that is a very good indicator, in my opinion, for the overall direction and trend of this company right now. But I wanted to come down to the profitability ratios because, this is where we might have a little bit of a problem. The return on assets, bouncing around from sub 4%, had a spike here to about 8.5%, and then pulled back to low single digits. But, last year, 2 years ago, it was at about 5.17%, had a pullback to sub 4%, and now slightly down again to about 3.5%. And if we look at the return on equity, again, bouncing around, had a big breakout year here up to 18%, then pulled back to single digits, reclaimed that double digit, and then pulled back to 7.75, now sitting at sub 7%. So a lot of these numbers are selling off. The return on invested capital here, 6.8% down to 5.1, now at 4.5%, excuse me. The gross margin percentage has seen about a 5% pullback over the last couple of years. It was north of 35% for 6 years in a row, then pulled back to 30.25%, now slightly above 30%. So a lot of these numbers may be showing us that a little bit of a sell-off is coming up. However, the company is still relatively healthy. The operating margin percentage again took a dip from 16% down to 13.25% last year. Now it climbed back up slightly to about 14%. The EBITDA, once again, earnings before interest, taxes, depreciation, amortization, the EBITDA margin was well above 20% for several years. Last year had its first dip sub 20, actually sub 19%. Now slowly climbed back up to about 19.1%. And we looked at the profitability overall before. The net margin percentage, again, about 8%, had a big spike, and then pulled back to, between 7, as high as about 11%. Pulled back to 7.8% last year, now sitting at 8.65%. So again, on paper, we do have some positives, we do have some negatives. However, the one thing I did want to show you is, if we go to the news, yes, it shows us here that Smucker lifts the low end of the full year profit range. I believe off the top of my head, the yearly EPS was, the range was 835 to like 875, and now they're saying 855 to 875. So anytime you hear something like that, that is definitely good news. But I wanted to go back a couple of weeks because there was a deal here with Post. Here we go. And yeah, 1.2 billion cash and stock deal, 700 million in cash, and they're giving them about 5.4 million shares worth $500 million. Now, this is an interesting play because Smucker's now, chances are the profit margins for these brands were not as high as other brands in other sectors in their portfolio. So they probably decided, well, let's just liquidate a few of these brands and we can bring in some cash, potentially some shares of another company, and we can use this money for whatever, our own share buybacks, or we can use it to accumulate some smaller brands that we feel will grow over the years for us. So the 700 million in cash is nice, but 5.5 million worth of Post, right? Now I wanted to switch over to Post for a second because check this out now. So Smucker's now has, again, 5.4 million shares of Post, but look at this. We have a company here trading about $90 a share close today, down 1.5%. We have a market cap 5.3 billion. Okay, keep it in mind. PE of only 6.6. The company's earning north of 14.25 a share. Okay, look at the EPS climbing quarter over quarter for the last 4 quarters for Post, including this last quarter, posting 108 a share above estimates of only 68 cents, with a surprise of 58% above analyst estimates. We switch over here quarterly, and you can see slow growth on the revenue side, climbing. Was 1.6 billion, dropped to 1.4, and now got up to above 1.5 for the last several quarters. But again, the profit margin slowly decreasing, which is why Post potentially may have wanted to grab some of these pet food names to not only just increase overall revenue, but of course consistency, right? The consistency of business, because people will consistently be grabbing these pet food brands for their pets to take care of them. But if we switch over here annually, you can see revenue bouncing around 6.25 billion down to sub 5 billion, and then had a nice rebound in 22 here, 5.85 billion, right? So the company has taken its dip, took it on the chin, and is now rebounding. Look at that profit margin, flat, 0.01%, and climbed up 3.3, now 13% for the year of 22 Post is sitting at. And if we pull up the financials of Post very quickly, you can see, look at the PE, 6.6. It's been basically decreasing for several years. Now it's trading at a ridiculous discount. Oh, also remember, we just said the company did 5.8 billion in revenue for the year. And if we come down here, market cap 5.3 billion. Okay, so again, Smucker's directly may not have extreme quick growth. However, they just got 5.4 million shares of a company that is really rocking and rolling as of late, and in my opinion is tremendously undervalued. Price to sales sub 1, when at times it was 1.4, 1.2 even, 1.44 here. So you can see a 40% increase here. Price to cash flow is the highest it's been. However, this may be before they gave $700 million to Smucker. So we don't know the new adjusted price to cash flow ratio. Price to book, look at this, 1.58, basically the lowest it's been since last year. But again, last year they were coming off the year before, which was one of their worst years. So this is understandable, but now climbing out of it, still being with a low ratio, in my opinion, is not understandable. Coming down here to the profitability, look at this. Was relatively flat several years ago, return on assets, slowly climbing. Look at that, 0.01, dipping all the way back down to flat, 0.83, 6.1, 7.2%. Return on equity, flat, 3.8, 24.5, now 29%. Return on invested capital, basically down the whole list, going from these flat years to single digits, high single digits, or double digits at times, and then completely breaking out, going from 1.1, again, 7.79%. Gross margin percentage is the only thing I'm seeing that's slightly decreased down to 24.25%, still up from the year before, though. Operating margin percentage, bouncing around, was double digits, pulled back to single digits, almost mid-single digits, and has now reclaimed 9.6%, almost back to double digits. The EBITDA, once again, earnings before interest, taxes, depreciation, amortization, was high teens, dipped down to low teens, now back to mid-teens at 15.5%. And the net margin percentage we looked at before, it was bouncing around, but it is climbing out as of late, right? And remember, Smucker, the original company that we were talking about, now owns 5.4 million shares of this company that is climbing on paper and, in my opinion, is undervalued. So you have all of that going for Smuckers. Switching over here to stock charts very quickly, we can see the Bollinger Bands. We're in a tight little range here, bouncing around, basically going sideways. And in my opinion, with the MACD curling here, it is most likely going to cross, and it is going to pull back to this 200-day moving average of 140.10. If we switch over here to the weekly very quickly, you can see RSI 52, right, still has some ways to sell off here. And look at this, though. You can see over the months and over the years, we're basically in this upward climbing channel, right? So if we were to draw these trend lines, you can see that this bottom trend line is coming right here, where this Bollinger Band is now meeting with the 50-day moving average of 139.46. Bottom Bollinger Band 140.27 with the MACD climbing down. So we have high 139s, low 140s. And again, this 200-day moving average on the daily is 140.10. So you do have those pullbacks going on. And if I pull up even a 1-year chart here, you can see, where a lot of this resistance is the low 40s, about 142. And if I even come down here to where you can say this big support was, we're looking at what? 136, 137. What did I say at the beginning of the video? Why buy at 147? We could potentially buy at 137. There you go. Chances are, in my opinion, it is probably going to pull back around 140, sub 140, and that, in my opinion, is when you should step in and buy shares. But that's just my opinion. This is your money. Whatever you do with it is entirely your own prerogative. But I'm going to leave it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, please drop it down in the comments section. I'm usually very quick to reply. Just like everyone on YouTube says, if you like the video, thumbs up. Really helps me out. If you appreciate the videos, subscribe to the channel. It means a lot to me. Moving forward, like I always say, I understand markets are rocky, they're volatile, and they're uncertain. So I do wish everyone success. I hope everyone makes a couple of dollars. Thank you for stopping by. I'll see you in the next video.